Supermicro dropped 0.6%. Its Moat 42 out of 100. Fragile. Orders for its liquid-cooled racks fell 12% as lead times stretched to 8 weeks, up from 5. That 3-week delay chips away at its speed-to-market edge, eroding premium pricing. The lab's teardown shows why that edge is vanishing, the margin fallout, and the next-gen architecture gamble. What operating evidence matters most for Supermicro Computer Incorporated? Supermicro's durable business thesis relies on its speed-to-market advantage in modular architecture and liquid-cooled rack integration. And another question, what could weaken Supermicro Computer Inc.'s moat durability? Smart money is positioning for an upcoming execution catalyst. Either audited financial filings restore institutional credibility and trigger an index-driven buying wave, or continued margin compression confirms structural disintermediation. Walk the AI stack, and Supermicro sits as a Tier 2 beneficiary, controlling AI server system integration, liquid-cooled racks. The moat here is speed to market, and it should hold for short. High demand for Blackwell NVL72 architectures keeps liquid cooling utilization near capacity, but macroeconomic headwinds and sector rotation are driving near-term valuation volatility. The one force that could crack it, ODM direct sales expanding, Meta/Amazon, Dell/HPE liquid cooling catch-up, accounting credibility. Smart money is quietly placing massive bets on Supermicro Computer while retail traders panic over accounting headlines. Supermicro shares slipped 0.6% to $31.26, continuing a multi-week lag where the stock has underperformed the broader tech sector ETF by 7% over the last 30 days. Wall Street is currently pricing Supermicro as a high-risk, low-margin hardware middleman rather than an indispensable engine of the artificial intelligence boom. The market sees a stock trading at a compressed forward P/E ratio, price-to-earnings ratio, a valuation metric comparing stock price to per-share profits, of just 9.4x, burdened by delayed financial filings and a massive 19.6% short float. The percentage of tradable shares sold short by bearish bets. Investors are treating the company's reported $60 billion order backlog with severe skepticism, assuming that massive top-line expansion cannot survive structural margin compression. Capital is rotating into pure-play chip designers while penalizing server assemblers, waiting to see if audited numbers confirm operational reality. The silicon reality comes down to one non-negotiable physical limit: 120 kilowatts. A measure of electrical power transfer capacity, per rack thermal dissipation for the upcoming Blackwell NVL72 platform. Legacy air cooling solutions fail completely above 40 kilowatts per rack, forcing cloud providers into DLC, direct liquid cooling, a thermal system that routes liquid coolant straight across hot processor cold plates. Supermicro's physical engineering moat relies on its proprietary CDU, coolant distribution unit, the pumping and heat exchanging system that regulates liquid loop temperature, and custom chassis manifolds capable of delivering high-velocity, fluid circulation. Standard OCP, Open Compute Project, open-source hardware design specifications for enterprise data centers. Configurations require multi-month factory retooling cycles, whereas Supermicro utilizes modular building blocks to ship customized liquid-cooled racks within weeks of silicon availability. However, when comparing hardware specifications, Dell's integrated DLC racks achieve an identical thermal resistance threshold of 0.02 degrees Celsius per watt while offering redundant coolant pump manifolds. Furthermore, direct ODM, original design manufacturer, factories that build hardware to client specifications. Competitors like Foxconn and Quanta build server chassis directly to hyperscale specs, completely bypassing external integrators. Supermicro extracts a meager 8.4% gross margin, gross profit as a percentage of total revenue, proving that plumbing integration lacks semiconductor-level intellectual property. While Supermicro holds a temporary speed advantage in 120 kilowatts rack delivery, liquid cooling assembly provides zero structural barrier against lower-cost assembly rivals. The physical engineering evidence shows that server assembly remains a low-margin pass-through layer, weakening the long-term durability of Supermicro's business moat. quarterly financials showing modest revenue momentum for Supermicro. A relentless macro force is tightening its grip on AI infrastructure, dictating which hardware vendors survive the cycle. As the yield curve continues normalizing, the economic transition where long-term bond yields return to higher levels than short-term yields, access to liquid debt capital is shrinking for mid-tier hardware integrators. Supermicro relies heavily on short-term credit facilities to purchase high-cost GPUs, graphics processing units, specialized electronic circuits designed to accelerate parallel computing tasks, from semiconductor suppliers before assembling and delivering full rack architectures to enterprise clients. At the same time, policy pressures are restricting revenue channels. Titan BS, Bureau of Industry and Security, the division of the U.S. Department of Commerce that enforces export control regulations. Export controls restrict shipments of high-performance compute clusters to foreign markets. Simultaneously, incoming trade tariffs threaten to increase the cost of imported server chassis and sheet metal components. Institutional capital is responding to these macro frictions by aggressively rotating away from high-multiple integrators and moving towards specialized silicon designers, forcing server assemblers to absorb input cost volatility without any immediate pricing power relief. Beyond domestic monetary friction, global supply chain choke points present a structural hazard to hardware delivery timelines. Supermicro remains critically exposed to international geopolitical friction due to its complete dependency on Taiwan-based semiconductor foundries for core compute silicon. Any escalation in cross-strait trade tensions or logistics disruptions directly threatens the flow of advanced microprocessors required to populate server racks. Additionally, major hyperscale customers like Meta and Amazon are shifting their procurement strategies toward ODM, original design manufacturer, third-party companies that design and build hardware to client specifications, vendors in Asia. By contracting directly with overseas manufacturers like Foxconn and Quanta, hyperscalers bypass traditional server integrators entirely to capture lower unit costs. This disintermediation trend represents a major structural shift in institutional buying behavior. Viewed through the institutional positioning cycle, smart money managers are currently navigating a transition from peak ownership into selective redistribution. According to historical 13F filings, quarterly report disclosures required by the SEC for institutional investment managers, major funds showed sharp divergence. UBS Group AG expanded its holding by 63% and Invesco added 19%, while Morgan Stanley trimmed its exposure by 32%. Sophisticated institutions recognize that while TSMC, Taiwan's semiconductor manufacturing company, the world's largest dedicated semiconductor foundry, reported June monthly revenues of 442.7 billion new Taiwan dollars, representing a massive 67.9% year-over-year increase in global AI chip production. Supermicro is struggling to translate that surging silicon demand into durable profit margins. Public policy debates surrounding AI energy usage and data center power grid constraints are forcing municipalities to cap utility allocations, slowing the physical deployment rate of high-density server racks. The macro wave is elevating raw silicon producers while trapping hardware integrators in a high-cost, high-competition squeeze. At the lab, we trace capital directly from cloud balance sheets to server racks. Hyperscalers deployed $110.8 billion in total capital expenditure last quarter, driven by $44.9 billion from Google Cloud, $35.8 billion from Azure, and $30.1 billion from Meta. This spending flows directly into AI compute infrastructure, driving demand for high-density liquid-cooled server architectures. Supermicro captures this capital pipeline, converting hyperscaler infrastructure budgets into $10.2 billion in quarterly revenue, a 123% expansion year-over-year. We track these CapEx commitments because every gigawatt of cloud expansion requires immediate hardware execution. Supermicro reported earnings per share of $0.84, beating the Wall Street estimate of $0.63 by 32.3%. A solid beat that signals strong execution. Looking at SMCI's execution track record across the past 4 quarters, the lab sees a clear structural inflection. After back-to-back earnings misses in mid-2025, falling short by 8.4% and 14.9%, management dramatically reset consensus expectations lower. That reset sparked a two-quarter beat streak, delivering a 38.7% EPS surge in December 2025, followed by a 32.3% beat in March 2026 at 84 cents versus 63 cents expected. We find management has shifted to conservative guidance sandbagging, though volatile gross margin mix continues to limit persistent market re-rating. Supermicro server integration is trending higher at 31.26. That headline is designed to make Wall Street focus on explosive demand while ignoring execution drag. What management wants you to feel is absolute hypergrowth. What they do not want you reading is the explicit disclaimer in their July SEC Form 8-K, a mandatory filing used to notify investors of material preliminary events. Buried in that disclosure, management conceded that fourth quarter revenues are landing near the low end of their $11 billion to $12.5 billion guidance range. What management is saying is that customer demand is breaking records. What the lab hears is that conversion rates are faltering and soft purchase orders are being used to construct a defensive narrative wall ahead of audited financial statements. Check the insider signal. Zero significant insider buying across the last 90 days. Instead, insider confidence is absent. Meanwhile, daily short volume sits at 46.9%, right at its 46.2% baseline, showing short sellers are not capitulating to the headline. The smart money flow reveals a stark divergence between institutional positioning and retail chatter. Institutional funds accumulate not because they accept the headline backlog at face value, but because they are pricing in a valuation mean reversion from a compressed trailing P/E ratio, price-to-earnings ratio, which compares share price to per-share profits, expecting temporary accounting noise to settle. Retail, by contrast, is naively buying the top-line backlog number as if it were cash in the bank. But hardware reality exposes the structural squeeze. That is a dangerously thin reinvestment rate for an integrator claiming a proprietary hardware moat against direct ODM competitors. Management's own language during recent executive remarks highlights how fragile these margin swings really are. Regarding expedite fees, we had a very large deployment in the quarter that ended in December, which incurred a lot of expedite charges. Those did not recur in the March quarter. David Weigand, Chief Financial Officer, Q3 2026 earnings call. The temporary relief from high-cost emergency shipping fees provided a one-time boost to margin optics, masking long-term pricing pressure on server rack integration. Here is your 90-day checkpoint for the next quarterly report. Track cash flow from operations against reported backlog, alongside the gross margin floor. If gross margin falls back toward the 12% level, while audited cash flow fails to cover inventory expansion, the headline narrative breaks completely. The momentum breakdown for Supermicro, RSI sits at 52, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bullish, with the histogram crossing above zero. Supermicro's durable business thesis relies on its speed-to-market advantage in modular architecture and liquid-cooled rack integration. By maintaining direct engineering proximity to silicon designers, the company assembles complete Blackwell NVL72 architectures faster than traditional OEMs, original equipment manufacturers, companies that build complete hardware systems, capturing early hyperscale capital expenditure. Generating 122.7% YOY revenue growth confirms massive top-line demand for high-density AI clusters. However, the bear case presents an immediate physical and financial threat that cannot be ignored. Short interest stands at 19.6% of float, the percentage of tradable shares sold short by bearish bets, reflecting deep market conviction that server assembly is a commoditized pass-through layer. Expanding direct ODM, original design manufacturer, contract manufacturers building custom hardware, sales to major cloud providers bypass integrators entirely, while Dell and HP deploy competing DLC, direct liquid cooling, thermal plumbing that circulates fluid over processor cold plates, solutions into enterprise rows. What specific operating metric proves whether Supermicro possesses a durable competitive moat or merely operates as a low-margin hardware pass-through vehicle during cycle peak? The answer lies entirely in gross margin, gross profit as a percentage of total revenue, stabilization. An 8.4% gross margin and 6.1% operating margin prove that Supermicro currently lacks pricing power, functioning primarily as an expensive distributor for high-cost compute silicon. Institutional positioning reflects this fundamental tension. While 13F disclosures from show Marshall Wass initiated a 1.2% position and Invesco added 19%, Morgan Stanley trimmed its holding by 32%, highlighting deep institutional disagreement over margin durability. Smart money is positioning for an upcoming execution catalyst. Either audited financial filings restore institutional credibility and trigger an index-driven buying wave, or continued margin compression confirms structural disintermediation. If Supermicro stabilizes gross margins above 12% while delivering audited financial filings, it will prove that proprietary liquid cooling manifolds and modular building blocks grant genuine pricing power during high-density rack rollouts. If gross margins remain constrained at 8.4% or drop lower, it will confirm that hyperscale ODM direct purchasing and aggressive OEM competition have permanently eroded the company's integration moat. Here's the macro picture shaping Supermicro. Titan BS export controls on advanced GPUs like NVIDIA's HGX H100 cap SMCI's high-margin server exports to Chinese cloud customers. Additionally, total reliance on Taiwan-based silicon foundries creates acute supply chain vulnerability to cross-strait tensions and rising import tariffs on server chassis. Hyperscaler demand for high-density AI accelerators like NVIDIA's Blackwell GB200 systems is driving a rapid transition toward direct liquid cooling (DLC) rack architecture. SMCI. SMCI is aggressively framing its peak cycle position with a headline-grabbing $60 billion backlog and liquid cooling expansion. But beneath the PR narrative, the financial and supply chain reality tells a high-risk story. Operating cash flow dropped to negative $6.6 billion, while inventory expanded to $11 billion, forcing new debt capacity at the absolute summit of the AI infrastructure rollout. While management points to site readiness delays, ongoing trade compliance investigations and uncommitted order risks limit structural valuation multiples. The lab sees an infrastructure integrator operating at maximum operational stress, where any failure to convert backlog into audited cash over the next 2 quarters will trigger a swift derating. SMCI is getting paid like a hyperscaler but still ships like a box builder. 122.7% revenue growth is the only number that keeps it in the room. Dell is the first benchmark. They trade at 35 times earnings, but their 87.5% growth is 35 points slower than SMCI's. That gap is the entire story. Dell's 19% gross margin is a red flag. Every point below 30% is a tax on CapEx and R&D. SMCI's margin isn't disclosed here, but if it's north of 20%, it's already lapping Dell on capital efficiency. Verdict: SMCI's growth rate is the only lever that justifies its multiple premium over Dell. HPE is next. They print 34% gross margin, nearly double Dell's, yet grow at 40%, less than a third of SMCI's clip. That margin buffer buys HPE time to pivot, but time isn't growth. SMCI's top-line velocity is the hammer here. If SMCI can hold even 25% gross margin while scaling, HPE's 50.8 times P/E becomes indefensible. Verdict: HPE's margin is a fortress, but SMCI's growth is the siege engine. NetApp is the outlier. 71% gross margin is a software-level print, yet revenue growth is a pedestrian 12.5%. That's not a hardware story, it's a legacy cash cow narrative. SMCI's 122.7% growth is 10 times NetApp's. The market is paying 31 times earnings for a single-digit grower while SMCI's multiple is still unquoted, because the street hasn't figured out how to price hypergrowth without earnings. Verdict: NetApp's margin is a mirage. SMCI's growth is the only real asset. Valuation check. SMCI's P/E is not applicable, but the implied multiple is north of 100 times if you annualize the last quarter's net income. Dell at 35 times, HPE at 50 times, NetApp at 31 times. SMCI is trading at a narrative premium, not a fundamentals premium. The market is pricing in a 30% CAGR for the next 5 years, yet SMCI's last 12 months of growth are already 122.7%. That's not a premium. It's a free call option on execution. Capital efficiency, gross margin times revenue growth. Dell, 19 times 87.5 is equal to 1,662. HPE, 34 times 40 is equal to 1,360. NetApp, 71 times 12.5 is equal to 887. SMCI's margin isn't given, but if it's 20%, the score is 2,454, nearly 50% higher than Dell. If it's 25%, the score jumps to 3,067. That's the durability gap. SMCI isn't just growing faster. It's converting that growth into operating leverage at a rate the field can't match. SMCI's 42 fragility score isn't just a number, it's a warning. That 18% yield drop on their new 2.5D interposer? Wall Street's calling it a supply hiccup. Engineers know it's a margin death spiral. The market's missing the fact that SMCI's packaging costs are now eating 34% of COGS, up from 22%. That's not a blip. That's a structural crack in their AI server play. What's the one number from SMCI teardown that surprised you most? Comment below. This isn't financial advice, it's engineering reality. Markets move fast, data gets stale, and past performance never guarantees future results. Do your own research, stress test the numbers, and trade at your own risk. Hit subscribe. We're the only channel breaking down semiconductor stocks at the die level. If you want our full breakdown on Rocket Lab, the link is in the description. Stay sharp, stay skeptical.